Good evening, everyone, and welcome to Forex Street webinar of 9th of December 2014. My name is Nenad, and today I will show you basic and advanced chart patterns. There will be some patterns which you probably didn't hear of, and I will definitely explain how you can trade all of those patterns. So before we begin, as always, our standard is disclaimer. Online educational materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get the corresponding information on charting conditions and other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk disclaimer, you're also proceeding further with me. And final part of risk disclaimer, Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the authority and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not the .co.uk website, but the globalnews.com website. Forex is risky business, and this is a personal opinion only, and this webinar is for informational and educational purposes only. So with having said that, we are ready to proceed. Basic chart patterns and non-standard and special patterns. We will talk about this today. So those favorite chart patterns which I've been trading definitely are head and shoulders, inverted head and shoulders, flat top ascending, flat bottom descending triangles, then W123 reversal, M123 reversal, inverted N and N123, and broadening top, or so-called megaphone. The thing is, when we talk about these patterns, every single one of those patterns is tradable except for megaphone. I never trade megaphone, and the only reason I have put this pattern in the chart and in this presentation is the example that I really don't like to trade megaphone. It's very hard to trade, and it's definitely not a tradable pattern. So we will talk about those tradable patterns, and I will show you new approaches how you can trade all of these patterns. So first of all, we can start with head and shoulders. Famous pattern, which is basically a reversal pattern, and it always shows up. We can see it even on lower time frames, higher time frames, but definitely the higher the time frame is, the more reliable the pattern itself. So when we talk about head and shoulders, this is the distinct appearance of head and shoulders pattern. To the left side, we can see a left shoulder. Then in the middle is the head, and to the right is right shoulder. And there are two approaches how we can trade this pattern. There is a conservative approach, and there is a modern approach. Conservative approach tells us that we should always, when we see head and shoulders pattern, that we always should draw a neckline, so-called neckline, from the left shoulder to the right shoulder, and basically when the line intersects and connects, that is called a neckline. So once this neckline is broken, we can take the short trade. Breakout trades you can trade with trigger happy, breakout retest continuation. Now, the problem with this conservative approach is that today definitely the market is not so kind as it was, let's say, 10 years ago or in the mid-2000s, because the market does not have so big ATR, especially those majors that are being heavily manipulated. And if we try to short the pattern near the bottom, so effectively if we want to short the head and shoulder by using conservative approach, we should short it here, exactly at this spot. And if we short it there, that means that the move has already happened. You can see the move from this point has already happened, and now it seems that this particular pair, in this example, euro dollar, is definitely too low to be shorted again. So how I do by modern approach, I don't know if anyone else does it, but the thing is, once head and shoulders start to form, I will draw a horizontal line. So we see a left shoulder, then we see a head, and then we see basically this is a sign that this can be definitely head and shoulders pattern. I will draw a horizontal line here, and definitely the area for short entry will be this. So I trade head and shoulders by shorting into the top of right shoulder, because it will give me better risk to reward ratio, and definitely it's higher to the top than if it breaks a neckline. So modern approach is you should always pay attention to it. When you see that head and shoulders is being formed, so this is the left shoulder, this is head, and this is basically the start of right shoulders. You just put a horizontal line from the left shoulder, just put a horizontal line and mark the area. So definite area for entry is this one, okay? So this is how I trade head and shoulders. So I don't wait for a neckline break, because neckline break can give us fake breakout. This breakout here was definitely a fake breakout, and once we are faked into shorting here, there is a big chance that our stops can be hit, because this movement has already happened from this place to this place, and it was definitely better to short it at the top of the right shoulder. But don't forget to put the area. You don't go with to the pip entry, because maybe to the pip entry won't happen. So you always draw a horizontal line, and when you see the first cue for making head and shoulders pattern, that head and shoulders is being developed, then you put a horizontal line, and from that horizontal line you draw basically like this. You make a rectangle, and that can be your entry to the short side. It's definitely better to short it here and there into this zone than at this point. So my approach for trading head and shoulders is definitely a modern one. So always shorting it from the top of the right shoulder. I just don't feel comfortable with trading it closer to the trend line, and I have witnessed many times that this pattern can definitely make a fake breakout to the short side. So especially if you trade higher time frames, I will definitely recommend that if you are price action trader, of course, or you use maybe indicator based system, but also you are relying on those patterns, and especially on higher time frames, it's better to definitely short it at the top of right shoulder than to wait for the neckline to be broken. Then we can go with inverse head and shoulders. It's the same approach with inverse head and shoulders than that is basically with head and shoulders. Inverse head and shoulders, you know the pattern. It's vice versa to, it stands vice versa to head and shoulders. It's a reversal, but reversal to the long side. And there are also two approaches, conservative and modern. Conservative approach is, again, you should draw a trend line. Once the trend line is broken, you can go with trigger happy, breakout, retest, breakout, pullback, continuation. So you connect your neckline. So this is the neckline. You can see breakout. 2 pips above the neckline, the entry is called trigger happy trade. If you wait for a retest and you open your trade here, it's called breakout retest. If you make your entry here at this breakout high, if this breakout high is broken, it's called breakout pullback continuation, because you're going 2 pips above this breakout point. So definitely I would definitely recommend trading it in a modern way, because if you see inverse head and shoulders in making, you can see this is the left shoulder, then this is a head. Now this looks like leaned right shoulder, so you can also take your entry here. But your definite confirmation is this is the perfect head and shoulders. Look, this one here. This is the perfect head and shoulders. But you can also see this, because this can be also so-called three Buddha bottom. I will talk about that pattern a little bit later, but pay attention to this one. So you can easily spot a left shoulder, head, and right shoulder. This can be called a leaning shoulder. So this can be a variant of inverse head and shoulder. But once you have noticed this pattern, again, this is left shoulder, this is the Q, basically. So you just draw your line like this, and you basically make up for, let's say, entry zone. The same again. So you can always enter when the price retraces to your entry zone. And in this case, it would be basically going long at the bottom of the right shoulder. Okay? So left shoulder, then we see leaning right, but then we see straight right. And look at this, to the pip, horizontal line, and this easily can be your entry point. Okay? And of course, if you trade longer time frames, you can scale in here. So once you master this modern approach, you can basically use a double entry approach. So in this, let's say in this example, you can open one position here, and if you're pretty comfortable and sure in your analysis, you can try to open it at the break of the neckline. So effectively scaling into a position. In this example, it's basically the same. You can open your first position here at the bottom of the right shoulder, then wait for a neckline and open another position once neckline is being broken. So when you see a breakout, pullback, continuation, or breakout, pullback, you can open another position, effectively scaling into a long position. And again, if you, let's say that you don't know what will happen at this point, you can see here left shoulder, head, right shoulder, and definitely you draw a line. So you can enter here at this point, making one entry, then making a second entry, and making a third entry here. Okay? Those are all variants of head and shoulders, inverse head and shoulders, but you can see that definitely inverse head and shoulder is a reversal pattern. Why reversal? Because this is the earliest sign that you can enter a market at the leaning shoulder bottom. Then this is also an early sign you can enter a market. But look at this. This is the first swing. This is the second swing. Using the first or second swing is usually the safest one. Now this is third swing. You can see the confirmation of the third swing. And then look at this. The price is making a direct jump to this point here. So once you spot this pattern, you can trade it on basically three different ways. Three different ways, but there are two basic ways to trade it. So from the bottom of the right shoulder, from the breakout point of the neckline, or if you see a leaning shoulder, then you can use basically bottom of leaning shoulder, then breakout of neckline, then again adding position here, and finally adding to a breakout. Okay? So how I trade, if I use a confluence, of course, I would always I can't say always, but if I see the trading opportunity, and if I see that really price is making bearish movement, I would definitely go short at the top of right shoulder on head and shoulders, or at the bottom of the right shoulder for inverse head and shoulders. And this is definite sign, look at this, that the price will reverse. It's pretty much clear. Downtrend, then it's closer to the top. then it's closer to the top if it breaks a neckline. I just am not comfortable with that old teaching which taught us that we should wait for the break of neckline. In today's market circumstances, how it stands, it's definitely better to short early or to long early at confirmation than to wait for some movement to happen, because it can easily reverse. Now let's talk about, this is now triangle, and this is not an ordinary triangle, because I won't be talking about ordinary triangle. Ordinary triangle looks like this, and that's basically a consolidation, right? Now all triangles are a form of consolidation, okay? But we need to distinguish between two types of flat triangles. This is so-called flat bottom descending triangle. This is flat bottom. You can see how many touches it has. Descending triangle. Flat bottom descending triangle usually is a sign of trend continuation. So if this was the uptrend here, this was when downtrend has started. At this point, when this triangle has broken, we can make an entry. Now again, breakout entries are, we make breakout entries in three different ways. Trigger happy, breakout retest, breakout pullback continuation. Okay? Once more, if you enter here at this point, this is called trigger happy. If you wait for a retest of a flat bottom, it's called breakout retest. If you make an entry at 2 pips below breakout point, it's called breakout pullback continuation. You usually add the widest part of the triangle to the breakout point, and that is your target. Okay? So once your triangle is broken, you measure the distance between the bottom and the top. At the break of the triangle, you add the same distance to the breakout point, and that is your target. Now, I need to remind you that this triangle is bearish triangle. It can happen that this triangle breaks to the upside. But then basically you will be trading counter trend with triangle. If you want to take trend trades with the triangle, then flat bottom descending is downtrend triangle. How you can know that this is downtrend triangle? Not just by doing the analysis of previous movement. This is definitely bearish movement here. But let's say that you don't pay attention to that. You just need to watch for descending trend line. Descending trend line is a sign that this triangle is bearish. Okay? Now let's see a different example. This is called flat top ascending triangle, and it's in its nature the triangle is bullish. But I did this example definitely intentionally because I want to show you that these type of triangles can have reverse breakouts. So we have here uptrend. This is definitely uptrend, right? And now we can see ascending trend line, which is also marking an uptrend. How would we trade this triangle with a trend trade? We would wait for a breakout for trigger happy, retest for breakout retest trade, or continuation for breakout pullback continuation. Now, you can definitely see in this example that the triangle can also be broken in contrary to the trend. So if you want to trade this basically breakout of ascending trend line, you would be going with counter trend trade. Remember, counter trend trades are not safe as trend trades. Why? Because trend trades are when big money is moving. Big money, big pension funds, big institutional funds, institutional traders, central banks, they are moving the market. Retail traders are not moving the market. Okay? So if you want to go with a trend, it's your safer option. If you want to go with counter trend, you need to use a good reason to go counter trend. The only reason when I would trade this type of triangle to the counter trade is if I, let's see, spot some divergence here, bearish divergence, then I can use with MACD, of course. Then I can trade breakout to the downside. But definitely trading it in trend direction is safer. Okay? So, flat bottom descending triangle is bearish triangle. It's usually traded to the downside. Then we have a flat top ascending triangle. It's traded to the upside, okay? And of course counter trend to the downside. Now, this is W bullish pattern. I did this analysis, I know it was, I think, yeah, it's November. It was in November this year, or I just cannot remember when this happened, but definitely this was my analysis which I did, and it was pretty much successful. I won't be talking now about confluence points. We have trend line, we have pivot points, we have a monthly trend line. We will talk about W pattern. Yeah, this is from November this year. W pattern, look at this, W. This is one of my favorite patterns. This is bullish reversal pattern, W. Look at this. And definitely if you're using it with a confluence, you can make some good pips. How the W is traded? So let's say we mark this point 1, this is point 2, this is point 3. It looks like W, right? Now, when you take the trade, once point 2 is broken, you can enter a trade. This would be trigger happy trade, obviously. Now, this trigger happy trade would definitely go in some drawdown before making profit. Now, this is, again, trigger happy. This is breakout retest, okay? And from this point, it's breakout, pullback, continuation trade. So W pattern is always traded at the break of the point 2. So if this is point 1, this is point 2, this is point 3. Once point 2 is broken, you go with your breakout trades. Usually stops are placed below point 3 because this is bullish pattern. We always go to the we always trade this pattern to the upside, and once point 2 is broken, we place our stops here, and we need to decide which one of those entries we would go with. Okay, so as I already showed you, we can go with breakout, so-called trigger happy, breakout retest trade, or breakout pullback continuation. So it's up to you definitely which kind of pattern you would decide to enter. Okay. Now let's see M. This is definitely contrary to W. If this is a bullish pattern, okay, if this is a bullish pattern, this is definitely bearish pattern. You can see it looks like M. So this is M reversal pattern. How it's traded? It's traded like W reversal, but just we use it to the downside. Okay? So this is point 1, this is point 2, this is point 3. Okay? Once this low is broken, we go with entry. So this is, and of course stops are placed here. And you need to take into account that these kind of patterns, if they are traded on daily time frame, you would need a bigger stop because you can see the movement. This is trigger happy trade. This is again trigger happy trade, and definite breakout retest happened at this point. So breakout retest trade from this point, it was continuation, and look how big the drop was. So M patterns are definitely traded the same way as W at the break of point 2, but we take the trade to the short side. Okay, when point 2 is broken, then we should decide which kind of entry we would prefer. Now this is 1, 2, 3 pattern, standard 1, 2, 3 pattern. You can see it on the chart, and this is how it goes. Point 1 is the high, point 2 is swing low, point 3 is a lower high. Okay, we see a lower high. So 1, 2, 3. Once again, point 2 is broken, we go with entry. This pattern is also inversed N, so it looks like inversed N, and it's a sign that the price will continue to the downside. So this is point 1, this is point 2, this is point 3. This is the indicator which automatically plots these levels. So once point 2 is broken, you can see breakout, trigger happy, breakout, retest right here, and from this point here, it's breakout, pullback, continuation. So this is inverse 10, okay? 1, 2, 3. Then we see N, or 1, 2, 3. It's definitely traded the same way like this, but this went to the short side, and we want to trade this to the upside, okay? 1, 2, 3. Point 1, point 2, okay, point 2, and point 3. Once point 2 is broken, we go with one of entries, okay? Same for inverse and for N. Just the direction is different. This is short, this is long, okay? And 1, 2, 3s are definitely good way to trade. You can couple 1, 2, 3s with moving averages. You can use range bars with 1, 2, 3. One of next webinars, I will show you how to use 1, 2, 3 with range bars. It can be pretty much powerful. And this is definitely one of my favorite patterns to trade. 1, 2, 3. Inverse then and end. Now, those were definitely those standard patterns which we like and we should love to trade because they are good. Especially 1, 2, 3s, Ws, head and shoulders, inverse head and shoulders, even triangles. Now, I will show you non-standard or special patterns, which many traders definitely don't know that these exist. Those are hook reversal patterns. So hook reversal, many traders trade hook reversal as I can say with bars, not with candlesticks, but I use this with, of course, with my Camarilla MACD candlestick patterns. Then we have 3 Buddha top, cup and handle, atom and atom, ascending scallop, running triangle, diving board, or V-shape reversal. This diving board V-shape reversal is particularly dangerous. So this pattern, I will show you how it looks, and this pattern you shouldn't trade it. You just shouldn't touch the pair when you see a V-shape reversal. I don't like it. And rooftop. Okay? Let's start with hook reversal pattern. This is hook reversal pattern. Now, what is the main thing in hook reversal pattern? Because for some inexperienced traders, this is pretty much hard to recognize. We should look for a pattern in a short-term uptrend. So we should watch out for uptrend. Then when we see uptrend, this is uptrend because we see swings. We can also put a trend line here. We see inside bar. This is inside bar. This is mother candle. This is baby candle. And this is inside bar, okay? This. Then after the inside bar, we will usually see some consolidation. At the break of the bar of the candle previous to the mother candle, we enter the trade, okay? So the main characteristics of hook reversal, this is hook reversal top, is we have inside bar. So this is the main cue that hook reversal is being formed. This is previous candle. Now, at the break of the previous candle, we go with one of 3 breakout entries. Breakout, trigger happy, breakout, pullback, breakout retest, and breakout, pullback, continuation. Okay? And what would happen usually is that the price will continue to the downside. This is hook reversal bottom. We see downtrend. Then we see inside bar, but at the support. Okay, guys? This is support area. And at the support area, we can see that inside bar has formed. This was the candle prior to mother candle. When this high was broken here, we go with entry. So trigger happy, breakout, pullback, continuation trade. Breakout, retest, whatever. But this is how the pattern is formed. The main cue for hook reversal bottom is again inside bar. This is inside bar. So mother candle, big bearish candle, baby candle, bullish candle. Previous candlestick, when previous candlestick top is broken, this is a sign for early hook reversal pattern. Okay? 3 Buddha top. Definitely it looks like head and shoulders, but there is some difference. There's some difference between head and shoulders. First, you can see a big volume which was put into this long head, long shoulder, because you can see that this is momentum candle, and definitely you can see the gap. Then you can see bearish candles, huge momentum candle, again gap, and then some retracement. And then what happens is you have basically head, which is a range. Look at this range. Up, down, up, down, up, down. And then you can see again the shoulder, which is not perfect shoulder, but it has a range in here. Okay? You can classify this as a sort of head and shoulders. But this is called 3 Buddha top. Third rally to the downside is always lower to the head. So it should never be up the head. It's always lower to the head. And you can even put some form of inner trend line here. But the characteristic of 3 Buddha top is the right shoulder is below the head, and you can see some consolidation at the head, and very often at the right shoulder. You trade 3 Buddha top, basically it's the same as head and shoulders. Shorting it from the top of the right shoulder or shorting it at the neckline. Again, if you're shorting it from the top of right shoulder, somewhere in this region, you have a consolidation. So you will always have on 3 Buddha top, you will have the time for your entry. So you always take a market order. There is no breakout, pullback, continuation at the top of the shoulder. Okay. Then you can take a trend line. That is a conservative way. You remember that, how you can take a trend line trade. It's definitely a conservative trade. And if you take a trend line break, then you go with breakout, pullback, continuation trade. The same breakout, pullback, continuation trade, guys. You remember that one. You traded the same way as you traded head and shoulders, okay? But the difference is the consolidation. The difference is a consolidation, and that right shoulder is leaned a little bit. It's lower than the head. Then we go with cup and handle. This is also interesting pattern. It's cup with handle. We have first basically some sort of uptrend. This is uptrend. Then we have basically a downtrend, which is making for some U-turn here. And then definitely the cup should be U-shaped. So it's not V-shaped, because if you see it V-shaped, it's V-shaped reversal. So we have a U-shape. This is U-shape. And then the cup, this is the cup, it must have a handle on the right. Okay? And cup rims should be near the same price level. How we trade it, we mark the cup, then we mark the handle. This is handle. Once the handle is broken, we go with breakout, trigger happy, then breakout, retest, or breakout, retest, continuation. Okay? So this is cup and handle. It's not so easy to spot, but those with experience with charting can spot it easily. It's called cup with handle. Okay? We have Adam and Adam now. Yeah, Adam and Adam. This is very similar to W, but basically the thing is on Adam and Adam, we have two distinct valleys. So this is one valley, and this is the second valley. And these two valleys look distinct, okay? These two valleys look distinct. When you see this pattern, this definitely is a bullish pattern. Adam and Adam is definitely a bullish pattern, okay? And how you can trade this pattern, basically you can trade it the same way as the W, but the only exception is you should go at the top of Adam and Adam. So if this is the top, definitely you should go long here, not here at this point break. So you should go at this point break here, okay? Then again, if you see, for example, Adam and Adam like this, so obviously this is the top and you trade it here. But usually on Adam and Adam, valleys will be looking pretty much similar. Look at this. So bottom and top would be pretty much close. And these two valleys are pretty much, look, they look the same. Okay? Maybe there is Adam and Eve, I don't know. Wojki? I know of this Adam and Adam and Eve, I don't know. But this is the way how we definitely can trade it. So it's not easy to trade. It's not so easy to spot. But once we spot a pattern, then we can definitely try to trade it. It's very similar to W. But again, as I'm saying, you should go at the top, not at the point 2 break. You should go at the top break, not at this point break here, okay? So this is the signal to go long. Again, I question, will there be a recording? I don't know. I think this webinar is being recorded, but you should ask Forex Street staff. I think there will be a recording. Why? I think that will be a recording, okay? But look, let me tell you one more thing, which is definitely that will clear that will clear difference between W and this pattern. If you see the top here, this is the top, okay? Okay, this is the top. Look at this breakout. Look how this perfect retest was. So this was the breakout point. Look, breakout point. Then look at this retest. Look at the retest. Retest. And look at the continuation from this point. So this is why you should concentrate on trading Adam and Adam at the break of the top. So if this is the break of the top, this is retest, this is continuation. Of course, definite stop for me would be somewhere below this region here, especially if you go with the retest rate. This is ascending scallop. Ascending scallop is it's very distinct. Ascending scallop looks like J letter. Okay, you should always concentrate to find a J letter here. J letter. Okay. Look at this J. It looks like J. And the thing is, we should find two peaks. Basically, we should have a rounded valley. This is a rounded valley, look. And when this high was broken, this was a ascending scallop. Now, the obvious question would be how you trade ascending scallop. I don't trade ascending scallop. This is the sign for me. This is the sign for me that the market will go to the upside. So once I see ascending scallop, I will definitely wait for a retracement, then enter a long trade. So J letter is ascending scallop. Ascending scallop is telling you that the trend is to the upside. Once the trend is to the upside, okay, you should wait for a retracement, then enter a long trade, okay? Wait for a retracement and enter a long trade. This could be a nice retracement for a long trade. And then again, we see ascending scallop. Look at this. So this is a good example because we see two ascending scallops. This is 1J and this is second. Look at this point. It's also W. So you see a confluence of different chart patterns which tells you that the trend is to the upside and that you are safe to trade. Take the entries to the upside. Okay? So definitely good reasons to go for a long trade. And one more thing which I wanted to show you, okay? It's called, look at this, a running triangle. This is bullish. We have 3 touches to the upside, 2 touches to the downside, and bearish. We have 2 touches at the ascending line and 3 touches at the descending line. So this is running triangle. This is the example of running triangle. 1, 2, 3. We have ascending running triangle, look. And we have a trend line at the upside. To the upside, it doesn't matter. It can be also, these are standard running triangles. Standard running triangles. But you can also use flat top ascending and flat bottom descending. So this is flat top ascending running triangle. Now the difference between running triangle and normal triangle is that running triangles do not have vortex. When we see a vortex of the triangle, then we know that that is basically a possible breakout point. When you see that that we have a running triangle, there is a signal, especially if the price is very close to the top of the running triangle, that the price can break out, and you should be ready for a breakout. So definitely you should pay attention to these type of triangles, and you always should pay attention to the breakout point. I already told you that ascending triangle is bullish in the nature. If you see a running triangle which has ascending trend line, then definitely you can go with a breakout, pullback continuation to the upside if you notice it. Okay? Breakout, pullback continuation. This is huge momentum to the upside. But because this triangle does not have a vortex, then obviously breakout can definitely happen earlier. The question of Boyke is, why do patterns repeat? Boyke, we always have history repeating in Forex. That is behavior analysis. All trading and most of the trading on Forex market is done by human mind. Those automated robots and high frequency trading robots are definitely the creation of us humans. Everything is balanced in nature. So we usually have good and evil, black and white. We usually have waves. Everything is in perfect balance. Patterns will always repeat because the history repeats itself. Every single of my analysis includes historical buyers and sellers. So if we already saw, for example, at this point in the history, that this was a buying point, I would definitely go long here because in the history there was buying. So once traders spot that this was a buying level in a close history, let's say, those orders will be definitely placed here because historical buyers, near-term buyers and sellers, are making up for a confluence on the charts. They're making up for the confluence, guys, on the charts. Okay? And patterns will always repeat because the history will always repeat. Everything is balanced. Everything goes in a balance. It's the law of the nature. It's the law of behavioral analysis. There is a science, behavioral analysis. We tend to repeat the patterns. We tend to repeat our habits, repeat our movements. Everything, even breathing, is repeatable. We inhale and then exhale. So that is the same with market. Market is a living entity. It's a living entity. And the shape of that entity is what causes us to basically, if we trade price action, to enter, re-enter, close, or take profit. The shape of it. It's again our psychology. And the last pattern which I want to show you today is called diving board. It's V-shaped reversal. And that is the pattern which I definitely want to show you because if you see this pattern, you don't want to go with, in this example, short trades. V-shaped reversal or diving board is the pattern which marks a strong, very, 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 very strong reversal to the upside. And in this example, you can see, in this example, it perfectly shows you the price went down. You thought you could short it here, but then what happened, usual stop loss is hit, and the price continues to the upside. Okay? Diving board, very nasty pattern. When I see diving board, it tells me do not enter short trade. Do not enter the short trade. And I definitely would never enter a short trade when I see this pattern. Definitely, guys. It's very nasty. It can be very, very cruel to us if we don't know how to trade it. And we definitely want to avoid it. Avoid any short entries when you see V-shape reversals. Definitely. Do not go with those kind of entries. Okay? Now let's see another pattern, and that will be definitely the last pattern for this day. It's called Rooftop. Rooftop is, again, Rooftop is, I like this pattern because it always shows near the tops. It always shows near the tops. And it's normally, for this pattern, that it has the name of a rooftop. We have upward action prior to rooftop, upward action. Then we see basically a horizontal or near horizontal bottom. You can see horizontal bottom like this. It doesn't need to be perfect, but it's again a horizontal bottom. Okay? And it looks like head and shoulders. Okay? So it looks, it's not, but it looks. Look at this. But it's a rooftop, look. It's definitely a rooftop. It's because it's called because of this shape, rooftop. And what is the confirmation of the trend reversal? This is trend reversal pattern. Again, close below the bottom of the rooftop. So if this is the foundation of the roof base, if the price closes below, as in this example, this is definitely a sign that the price can go down. And we can see here, breakout, trigger happy, breakout, retest, and from this point it was breakout, pullback, continuation. So guys, I hope that you enjoyed the webinar. If you have any questions, you can ask me now. We have come basically to the end of the webinar. If you have any questions, you can ask me. This webinar is being recorded. It should be uploaded. So you can always refer to the webinar if you spot this pattern. Okay, guys, I don't see any questions. Thank you for attending. I will be here with you soon. And if you're trading price action, you should always pay attention to possible chart reversal patterns. Those will save you from losses, and also those will give you entries. Thank you for attending, and trade safe.